Peloton has been through a number of huge challenges over the last 3 or 4 years. Obviously, they were one of the pandemic darlings, obviously got very overvalued, made a lot of mistakes with their hardware, took on too much debt to buy a manufacturing company, tried to make the transition to being an app company. Fitness anywhere, anytime was their slogan, and that doesn't seem to be going particularly well. So there were some recent changes made in the company's earnings announcement. They're going to be focusing on cash flow, basically on the core part of the business. People who have bikes like myself and simply just pay their monthly fee. Those are very, very loyal customers, very, very low churn, very high margin. So that's a great place to be. The problem is Peloton has a lot of debt. And to answer that, they recently went through a refinancing of at least some of their debt. So I want to go through the major changes and kind of take a fresh look at Peloton, because this is one of those companies that I think could be a compelling option as the go-to place for streaming fitness content, but it just hasn't lived up to the lofty goals that investors had. Given the fact that most investors have actually given up on the stock, maybe now's the time to reconsider. But let's dig through that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go to the recent announcements. This is an announcement that came along with their recent quarterly results. Also announced at the same time that the CEO was going to be leaving the company, Barry McCarthy. He was brought in to really go through this major transition, getting the company back to free cash flow positive, which barely they did last quarter. But they announced a bunch of huge cost cuts expected to reduce run rate expenses by $200 million by the end of fiscal 2025. That's only about a year from now. So these are going to happen pretty quickly. Said that they're going to reduce headcount by about 15%, reduce the retail showroom footprint, and reimagine the international go-to-market approach. I think the real way to look at this is that Peloton is going to be focusing on this segment right here. Connected fitness subscriptions is what they call it. This is the premium subscription. This is people that have hardware, very, very low churn of only about 1.2%. And there's over 3 million of those subscribers. This is going to drive the subscription revenue number. That's a majority of Peloton's revenue now, and also a majority of the company's gross profit. What they're going to put less focus on is these app subscriptions. These are dropping quarter over quarter and huge churn. 9.2% churn is just unsustainable for a subscription company. That means you're losing almost 10% of your customers every single month. So that business has not been what a lot of us thought it could be. So they're focusing on what they do for their core business. That's really the way to interpret those cost changes. The other thing that you have to do is get your balance sheet at least reasonably correct. In total, this is over $1 billion worth of financing. They said they were going to offer $275 million of principal debt, convertible notes, I'll get to the pricing of that in just a second, and entered into a $1 billion 5-year term loan facility, along with a $100 million 5-year revolving credit facility. What are they going to do with that cash? Well, they repurchased approximately $800 million of 0% convertible notes due in 2026. So these were convertible notes, 0% coupon. So likely these are trading at a pretty good discount to their par value is what you would call it, but they were due in 2026. That means that Peloton either was going to have those convert into stock, which wasn't going to happen because the stock has dropped. So it was going to have to be paid for in cash. This basically takes that uncertainty out of things until at least 2029 when these notes are going to be due. The downside is these $300 million in convertible notes have a 5.5% coupon rate. That means that Peloton is paying interest of 5.5% on top of the fact that if the company does well and recovers, these are going to be dilutive because they're going to be converted into stock. The initial conversion price is about $4.58 per share. So again, could be pretty dilutive depending on what happens with the company. But what this does is it takes some uncertainty out of the balance sheet, allows management to focus on improving that free cash flow. So if they can take that as $200 million in cost savings, maybe save some other costs, increase revenue a little bit, this could be a company that's generating $200 to $300 million in free cash flow long term. That would be pretty reasonable given the balance sheet. You can see here, this is the balance sheet as of March 31st. There's about $800 million worth of cash. And here you see the debt that was on the balance sheet, a current term loan of $692 million and the convertible debt that I talked about earlier, $991.4 million. We'll see exactly how this changes when they report their next quarterly results, because this will include the conversion to the new debt and term loan and the reduction of this debt outstanding. So that's really the thinking behind things at Peloton. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So is this enough for the stock to recover? Well, right now at $3.14 per share as I'm recording, the company's market cap is about $1.2 billion. You still do have a significant amount of debt on the balance sheet. Going to be hovering right around that, probably that $1.3 billion range. On a net basis, you can take out the cash that's on the balance sheet. It's maybe going to be a little bit lower than that. But what Peloton really needs to do is get to the point where it's free cash flow positive and has a much more sustainable business model. I think where the stock is trading right now, this doesn't need to be a growth company, but it does need to be a company that's sustainable and can just generate cash flow to pay its bills. Once you get to that point, then you can start to figure out what are the growth avenues for Peloton. And I still think this is a company in the fitness space that, yes, there's a lot of changes coming out of the pandemic, maybe not as many people buying bikes, but they're moving into the treadmill market. That's supposed to be twice as big as the at-home bike market. There's opportunities to grow with commercial fitness, whether that's at commercial gyms or at commercial buildings like hotels, like office buildings. A lot of compelling options for growth, especially if you're focused more on a smaller segment of the business. If you're not doing the app business and you're not trying to push that, confusing customers with, do I buy hardware? Do I just sign up for the app? At this point, I wouldn't be surprised if they get rid of that lower cost app and they just say, hey, maybe you have some free initial content that you can sign up for in the app, but if you want to go for the full $44 per month for the full subscription that you can use on a bike or a treadmill as well, that's really where they want to push customers. I mean, that's a pretty compelling price point for what you get with the app, especially given where the prices are for gyms right now. I mean, gyms have gotten crazy expensive whether you're looking at a boutique gym or a full service gym. So I think Peloton is doing the right things from a strategy perspective. That doesn't necessarily mean this is going to work. I thought the same thing was true with the app focus and trying to be the streaming company in fitness. That clearly didn't work out, but we do have more evidence that this focus on the connected fitness customer that is a very low churn rate is going to be something that's probably going to work out much better. There's probably an opportunity to squeeze a little bit more cash out of each of those customers, maybe go from $44 a month to $46 or $48 per month. That's probably not going to lose you a lot of customers. If they can tack on 5-10% more customers per year, this could be a pretty nice, steady growth company if it gets to positive free cash flow. I'm not selling my shares because I want to see this turnaround work a little bit. Refinancing is part of that, and the cost reductions are part of that, but definitely not a certainty that Peloton is going to be a success. But what are you thinking about Peloton right now? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.